Good to see everybody. Welcome to this live session. And I am just relaxing at home right now, and I'm dressed up because after this, I've got to go out to a meeting. I hope that you're having a wonderful Monday, and welcome everybody. I see Pantawan, good to see you. And for everybody else, let me know if you join. Feel free to say hi. And also remember, I'm going to remind you probably 10 times to ask any questions that you want. So feel free to ask those questions. I was really great to go see the live event with Phenomena the other day. For those people that were there, nice to see you. And good afternoon, the Inspired by Me. Good to see you. Welcome everybody, and I'm going to be updating the performance on the all-weather strategies in this session. So also this gives a chance for you to ask any questions. This session I will be making some changes, and I'll describe those changes to the strategies so that you can get a picture of that. Tarinrat says Sawadi Krap. Good to see you, Tarinrat. And welcome everybody else. We've got about 163 people on the call from different locations, Facebook, YouTube, Twitter, or X. Chan Pen, good to see you. Hello. Welcome, everybody. Feel free to say hello. Most importantly, feel free to ask any questions you may have about anything. So, all right, let's get started. I'm going to get into the presentation now, and I'm going to share it. Yep, there it is. And I'm going to go through some points on this. So the first thing is that this is for February of 2024's performance. In addition, we are going to have some slight changes to the portfolios, so I'll talk about those. As I often say, make sure to ask questions in the chat. I love your questions, and I'll do my best to try to answer them. I just had a double espresso, which means I'm ready to go. Remember that our strategies are global, they're long-term, and they're diversified. These are the core principles that we're going after. And just remember, big picture, why are we here? To build wealth over the long term. And there's three pillars of investing I just wanted to remind you about. The first is be broadly diversified. Another is to contribute regularly. And another one is to stay invested over the long term. I outline a lot of these and much more in my book, How to Start Building Your Wealth Investing in the Stock Market, which you can get in Thailand. Now, our goal is to deliver steady returns over the long run. And here you can see our three portfolios. AWS, the red line, was launched in February of 2019, and we're targeting about a 6% return. Alpha Focus was launched in October of 2021, and we're targeting an 8% return. And All Weather Inflation Guard was launched in July of 2022, and we're targeting a 4% return. Those are the three strategies that we're talking about. So from when we started the Inflation Guard, in other words, we had all three portfolios going, the strategies are performing almost as expected. So the moderate risk AWS, though, has just been on a tear. It's done so well. Remember, this is after fees. Inflation Guard has the lowest return, but also the lowest volatility, and that's exactly what we expect from Inflation Guard. And also what we can see is that the all-weather Alpha Focus has started to really come back. And as I've said to people, it's just, it's a matter of time. That's a more aggressive strategy, and eventually it's going to catch up with AWS, I would expect. Now, since July of 2022, all strategies were below world equity, but with lower volatility. Remember, what we're trying to do is take away the issue of the volatility. So we mix asset classes rather than hold pure equity to try to avoid a portion of equity market downturns. But of course, that's going to mean that we're going to miss a portion of the market booms, as we are right now in the rise in the world equity. But I would rather have a smoother ride with a little bit lower performance than to have a really wild ride. And that's what we're going at with these strategies. For those people that are comfortable with the wild ride, then they just go with equity. Now, we create our strategies with the idea of thinking in decades. But truthfully, our aim is to create these that really perform over the long run. So let's review all-weather strategy. It gained 3.9% in February. Since inception, the strategy was up 40% and 16.5% above a 60-40 portfolio. And remember, that's after fees. Here we can see in February, the strategy was up 3.9%, which was 2.1% above the 60-40. It was simply rocking in February. Our 25% allocations to develop Europe, Japan, and the US were the top performers, as we can see. Don't expect it every month's going to be like this, but we called it almost perfectly right. Now let's look at all-weather alpha focus. It gained 3.1%. Here we can see that since inception, the strategy was down 2.9, but 4.4% above a 60-40 portfolio. And here we can see that it's 0.7% below world equity, but a lot less volatile. So in February, the strategy was up 3.1%, which was 1.2% above the 60-40. And the strategy was 1.1% below world equity. And our 22% tilts to world infotech, world energy, and Europe small cap underperform world equity to various degrees. So our bets weren't great, but our bets weren't huge compared to where our exposure was. So let's look at all-weather inflation guard, which gained 0.5% in 1 month. Here we can see since inception, the strategy was up 5.6% and 6.7% above a 40-60 portfolio, which is the benchmark we think is reasonable. The strategy has also experienced less volatility. Here we can see all-weather inflation guard was up 0.5% in February, which was 0.3% below the 40-60. So a little bit of underperformance relative to the benchmark in February, though it was still up by 0.5%. The World Equity Fund continued to outperform the MSCI All-Country World Index. And our 5% target allocation to World IT also did well. But global bonds, gold, and tips were a drag on our performance. So let's look at the global outlook that guides our asset allocations. But before we do that, I'm going to go to the questions. If you've got any questions, make sure to put them in the channel, and I'll be sure to try to answer those questions now. Let me look at those questions for a moment. So let's see. So we see, just want to say hi. I see, what is that? I don't know if I pronounced that right, but saying hi from Hua Hin. Nice to see you. And here we can see Chan Pen says, looking forward to seeing AWS strategy for March. I hope it does well in March too. Never know. And just to go through some of these, Pit Chipon says, it's rare I can catch your live sessions. Well, we've got it now. So make sure you ask questions if you guys got any. One of them here we can see, I heard AWS has no incoming changes in the portfolio. I'm quite curious. Well, I am going to go through that and go through all the strategies in just a moment, but I just want to take this time. We have nearly 200 people on this call, and I just want to highlight that this is the chance to ask any questions that you may have about when you should allocate, about any questions about investing that you've got in your mind. So make sure to take that chance, right? And one of the questions is, should I invest more in AWS now? Well, I'm going to explain the answer to that by saying that with my framework and my strategy, the best time to invest in my strategies is right after I rebalance, right when I rebalance. If you're waiting, it takes about 3 months before we get to the next rebalance. Let's say you're a week before the next rebalance. It doesn't really make sense to add more money to it then. But after we rebalance, that's the time. And that is what we're talking about today, is the rebalancing. So the answer is, from a strategy perspective, now is the time to invest. From an investment perspective of what the performance should be, I think it's important, John Penn, to remember that I'm not your advisor, and I can't be advisor to anyone here because I don't know your situation. But what I would say is that I've designed these strategies to be long-term and try to protect some on the downside. And if that fits your situation, either by evaluating it yourself or talking to your advisor, then continue to buy. Let's see what we got. Mika says, do you think it's a better idea to switch from AF to AWS? I've stayed with AF since the beginning. I would say that my answer, the first thing you have to consider is consider your risk tolerance. Alpha Focus is a higher risk, and therefore, if your risk tolerance is higher, stay in Alpha Focus. Remember, it's just good times right now for AWS, but that won't be forever. And then Alpha Focus will have its day also, and it's starting to come back. So just because performance has been bad in Alpha Focus, I don't think you should rush to get out and then switch to AWS, because maybe we're in for underperformance by AWS relative to Alpha Focus. Both of those strategies are very carefully designed and thought out. So my answer to your question, Mika, is I wouldn't necessarily switch to AWS thinking you're going to get better performance there. You may find that after you switch, in fact, the performance starts coming up in Alpha Focus. If that answers your question, I hope so. If not, feel free to ask more. Yes. Yeah. T says, so you'll rebalance today. Yeah, I'm going to show you the rebalancing in just a bit. Who will be U.S. president? Oh, I know that. That's easy, ABB. It's going to be Gavin Newsom. You want to make a bet on that? All right. Next. I'll wait for the rebalance. Okay, well, it's time to go into some of that rebalance in just a second. Before we do, just want to highlight, feel free to ask any questions that you may have about the strategy or anything else that you may have about investing. All right, let me go back to the presentation and let's go through it a little bit more. Now, the 3-month government bond yield has risen to about 5.6 from 4.9 a year ago. So in other words, short-term government bond rates have basically been flat. And the yield curve inversion has dived actually deeper. The turn has historically signaled a recession. And that would imply that we are in overtime right now. I had said at the end of last year that I thought the recession could come in the fourth quarter or the latest by the end of the first quarter of this year. Well, we're getting close to that first quarter now, and I would say we still are very close to when I think we're going to be in a recession. Of course, it is an election year, so it's very possible that the Fed tries to pump things up. But I would say my expectation hasn't changed. I still think we're going into a recession, maybe by the end of this month or next month or the month after. Now, the market, and I would say that's different from the market. I think most people right now are thinking that we are definitely in soft landing territory. Now, the market is pricing in a 95% probability for a continued pause at the next FOMC meeting. And the market expects the Fed to start easing in June. Previously, it was May. And so we can see that there's an easing where the red bar is going up. And so everybody's expecting an easing. We have a soft landing. Falling rates typically have an expansive effect on the economy and ultimately on the stock market. I would be different from this in the sense that I would expect that the Fed is going to drop interest rates down to almost zero, because once that recession hits, it's going to be hard. Now, ECB, the European Central Bank, and the Bank of England are expected to move in tandem with the Fed, while the Bank of Japan is still ultra loose at zero, the green line. Now, global bonds bring diversification benefits to the portfolio. This is one of the bonds that I use, and I'm just going to grab my pen here. So SCB Globe is one of the bonds. And what I'm showing here is about a 35% or so correlation. And that basically what that means is when the stock market goes down, it's not going to go down as much if you've blended in some of this bond as an example. Now, oil prices can remain high, and we've actually been seeing them above trend line right now. OPEC Plus members likely are maintaining voluntary supply cuts into second quarter. And if demand is sustained, there could be an upside in oil prices. Now, oil price has driven commodities in second half of 2023 and into 2024. The S&P, what we can see here is energy, meaning oil prices, the blue line has been accelerating faster than non-energy and commodities. Now, the S&P GSCI index has a 61% weight to energy, while many available commodity funds have less than 40% in energy. We currently don't see many catalysts for the non-energy sector right now. Now, the global economic growth outlook remains uncertain. The main upside in commodities would come from a supply shock or other factors. And gold is protecting value in times of uncertainty and market downturns. Gold has been on a rise, but remember, we don't invest in gold to speculate on gold. We invest on gold to protect when a downside comes. All right, it is time, ladies and gentlemen, to announce our new allocations. Are you ready? This is exciting. Well, for all weather strategy, no change. We keep everything the same. We're going to continue to ride the US, develop Europe, and Japan. That's our main 25% allocations. Now, the US still dominates global financial markets, and the US stock market can show resilience with massive and well-capitalized companies driving the market. We have a 25% target allocation, and the US is then about 30% of our total equity allocation, which is still significantly below the 63% weight in MSCI All Country World Index. A no recession scenario appears to be priced in, which constitutes a risk if the Fed fails. Now, Japan and Europe trade below US equity. We can see Japan is really starting to race up in the CAPE ratio, the 10-year ratio, the 10-year earnings average ratio. And we can see that Japan and EU have seen bigger improvements in consumer confidence, mainly because they fell quite a bit. But purchasing managers have become more optimistic also in the EU. You can see the index is now approaching the 50% or 50 mark, which means it could be moving into expansion. And the peak rate is expected to have been reached in the EU, and EU companies are resilient. They're used to operating in sluggish growth, and being a global leader in industrial automation, the EU could benefit from reshoring. Investors have low expectations for the developed Europe economic outlook, and we see a chance for the region to surprise on the upside. So we're keeping 25% target allocation. Japanese companies have been hoarding cash over the decade, and they're now sitting on about 48% of GDP in cash. This opens up for share buybacks, investments, acquisitions. Now, the top three things that matter in the Tokyo Stock Exchange effort to reduce valuation discount are: ensure companies are investable with large enough market cap, trading volume, and float, and make companies deploy or pay out cash rather than hoarding and sitting on it, and full and simultaneous English reporting and disclosure to attract foreign investors. Now, these are what I would consider to be the three most important things, and I've looked at all the different things that they're doing. Most improvements are recommendation and voluntary, which could make it hard to get adoption across the board. So let's talk about all-weather alpha focus. We have added 22% to India, and we're exiting world energy. That is the big change for alpha focus. We're moving in again, back in to India. We also changed our core global equity fund to Be Global. We've decided to do that because Be Global has delivered better returns on an absolute and risk-adjusted basis, and the long-term performance there has been quite strong. We're already using Be Global in the all-weather inflation guard, so we're familiar with this instrument. Now, small caps typically perform better in a recovery, and Europe could surprise on the upside, and smaller companies generally have better growth prospects and are more agile in capitalizing on new opportunities. And that's the reason why we're in there. we keep a 22% target allocation to Europe small caps. Now, this time it's different, seriously. At least one thing that is different this time compared to the late 90s is that many of the big tech companies are quality companies. And compared to the 2000 dot-com bust, the tech companies now are making massive amounts of money. These companies have high ROIC, or return on invested capital, and strong balance sheets. And quality stocks should do better in an environment of higher interest rates. So infotech has driven the market. We can see much of the 2023 and 2024 performance of the US market has been driven by tech. And we think the momentum driven by positive AI sentiment can continue and have a 22% target allocation to world infotech, as you can see through the B Innotech fund. Purchasing managers are optimistic in India, indicating a strong underlying economy. The service sector is most optimistic, with the latest reading at 62%, but manufacturing is in expansion mode as well at 57%. India has strong momentum supported by optimistic outlook, so we've added a 22% target allocation. In the near term, strong global retail investing and supportive fiscal policy can drive the market further. And in the long term, there's a narrative that India can become the new global growth engine after China. So as you can see, we're making a bet on India right now, going back into it after having been out for a while. And lastly, all-weather inflation guard. We've raised equity to 30% and we're reducing gold to 5%. You can see we've added 5% to world financials. We've reduced tips by 5% and increased global bonds by 5%. And we've reduced gold by 5%. Now, financials are expected to benefit from a more stable rate environment, and we've got 5% to world financials. High interest rate volatility is troublesome, though, for financials, and interest rates might be kept stable for another 3 months at least, and financials could start closing the gap since the U.S. regional bank crash in March of 2023. Now, before we get into Q&A, which hopefully you've got some questions, remember, for those people that want to join the Valuation Masterclass Bootcamp number 15 starts on May 13th. It's incredible. We just keep rolling. We help finance professionals become valuation experts in months rather than years. And we have many previous students and attendees coming from Phenomena. Here are some of them: Chachada and Tosapon and Takon or Kelly, Jutamas and Bunsim and Pongsokon are all students that came from Phenomena, and we look forward to welcoming you. In the Valuation Masterclass Bootcamp, you get a 6-week guided intensive online valuation bootcamp, daily live sessions, you get team support, progress tracking, and you write and present a professional valuation report. You can get an extra $100 off, so you're saving $900 and get 6 bonuses today. That's 6 bonuses. It's crazy. All you got to do if you're watching this video is use the Phenomena coupon code or go to valuationmasterclass.com/bootcamp. Now it's time for Q&A. So let me now switch over to that. Hold on. By the way, if you don't want to attend the bootcamp, send your children. I'll teach them everything they need to know about valuation. All right. Okay, let's see. ABB says, let's go through some questions. ABB says, who? Yeah, Gavin Newsom. He's the governor of California. And he's done so well in the eyes of the Democrats that I expect Joe Biden won't be able to survive until the election. And the Democrats are going to swap him out for Gavin Newsom. That's my expectation so far. Okay, Surata says, stocks or bonds have the potential to earn higher returns. Always stocks. The answer to this question is always stocks. And Suratas, what I want you to remember is that when you invest in a company, you're investing in a CEO and a management team, and they're constantly working to try to grow their revenue, improve their products, increase their profit margins. No other product or no other investment opportunity provides you access to a management team and their upside as they do better and better. Now, of course, a government bond or a corporate bond coming out of that management team is also good, but it's not going to get the upside of the hard work. And when you own thousands of companies through mutual funds, you're getting the benefit of thousands of CEOs and thousands of management teams. And with stocks, you can get that upside. And that's the reason why over the long term, stocks have been a pretty good investment relative to all others when it comes to, in particular to inflation. All right, let's look at another question. KT says, why your AWS port choose topics instead of Nikkei 225 for Japan allocation? Well, it's because we looked at all the different instruments, and there's something of the characteristics about this that we find most attractive relative to the others. But I can't tell you exactly why those two are, different. So I'm not sure if I got a good answer for that, but I can try to look at that and get back to you on that. All right, next question. What do you expect for ROI of AWS this year? Well, this is where it gets very difficult. Basically, people always ask me, like, what's the return going to be? And I say, well, on average for AWS, we're targeting 6%. That's it. Now, you may put your money in and find out that it goes up by 12%. Fantastic. That was just a good timing. But it is quite possible that it could go down by 10%, let's say. But why are we looking at long-term in decades? Because we want to look at the return over a long period of time. So when I'm talking about 6% on average, it is a long-term average that I'm expecting. But I believe that nobody can really tell you what the return on investment is going to be for anything, because it's all based on the future. So my answer for this ROI is, I don't know, but I'm going to stick with 6% for long term. All right, next question comes from Peach Upon, says, are there any market sectors you wish the portfolio had invested in during the last years? No, because I don't go back and think about it that way, because I can tell you, if you go back to the stock market and you look at, let's say that there's 10,000 companies that you could invest in around the world. I guarantee you, you're always going to be missing some. You could be missing thousands of stock that goes up more than your portfolio. But that doesn't mean that you're wrong, and that doesn't mean that you did the wrong thing. You're never going to be able to get all the opportunities out there. So I never look back and wish that I had been in this or that. I look at where I am, and I look at the decisions I made. The decisions I made in the last 12 months have been based upon my model and my framework. And as long as I stick to my model and my framework, I don't regret that. So that gives you a picture of how I think about it. Chalermpat says, what's your view on emerging markets? Yeah, I still, I think we have a lot of opportunity in emerging markets. I think you have to accept the fact that emerging market returns have been pretty bad. Look at Thailand. Thailand's been one of the worst as far as the profitability. So emerging markets have been hit pretty hard when it comes to profitability relative to the US tech in particular. So from my perspective, I think that over a 3 to 5 year perspective, emerging markets is going to be great. But over the next 12 months, maybe not. And part of the reason is because the US is really going to war in some ways with China. And I think that they're going to keep the pressure on China, and that's part of emerging markets. Suratas says, thank you. You are welcome. All right. Next, Chanpen says, I invested only 10% to AWS last year. Yeah. Well, all right. Other questions. I appreciate, Chanpen, that you invested that, and I'm going to try my best to try to keep the performance going in all the strategies. Feel free to ask any questions if you have any. But that gives you a picture. We got a little bit of changes to the portfolio, but the main change really is India into the portfolio. That is the main change. So do we have any further questions? Feel free to ask any questions now. You're welcome to ask anything, and I'll do my best to try to answer those questions. Okay, let's see this question. All right. So the next question comes from KT. What's your opinion of the US dollar Thai baht rate? I see you pick mutual fund with hedging protections such as healthcare in AWS. Over the long term, cost of hedging will be high. Well, I think that the cost of, I don't think you can get hedging any cheaper than you can get through these mutual funds, because they're pulling together all of us and then hedging the overall portfolio. And because they're related with banks, they get preferential treatment and preferential rates. So I would say that if you want to hedge, hedging through a mutual fund is probably one of the most low cost ways of doing it. You couldn't do it on your own at that type of price. Now, you're asking me about my opinion about the US dollar versus the Thai baht. I would say that I'm pretty negative on America and on the US dollar, but I also know that between the Fed and the US military and the US politicians, they'll do whatever they can to try to keep the dollar up. And they have the strength to do that over the next 5 years or so. So it's you have to be very careful betting against the dollar right now. But I think the longer term trend is negative for the dollar. But I wouldn't say that I'm taking a strong, active hedging position. I'm looking for what I think are the best funds for what I'm trying to achieve. And then I consider the amount of hedging that they've got to try to understand, what I'm getting with that. But I'm not making the decision on the allocations based upon my expectations on the exchange rate. Chalernpod says, how about your view on REITs? I don't have REITs in the portfolio, mainly because REITs are highly correlated with the equity market, which basically means if stocks go up, REITs go up. If stocks go down, REITs go down. So it doesn't bring a lot of benefit to my portfolio selection. In addition, those REITs are mainly all listed in the stock market. So by buying the stock market, I already have exposure to those REITs. So that's some of the thinking that I have on REITs, that I don't look at them as a separate asset class. I would say that land is a separate asset class, but REITs are behaving a lot like equities. All right, next question from John Penn says, and I'm thinking to invest more than 90% to AWS now. Yeah, as I say, I can't give you exact advice because I'm not your advisor, but just be thoughtful in what you're doing. All right, next, ABB, NVIDIA valuation in your view is crazy expensive in my view. That doesn't mean the price can't go up. It can, but I would say a lot is priced into NVIDIA nowadays. T says, it's a bit curious that you put India more in the port, but AWS does not change. Why? Well, because in AWS, I don't break out the country of India like that. I only break out the very large and liquid countries, which are the US and Japan in particular. Those are ones that I'm able to break out in AWS. That's the difference between AWS and all-weather Alpha Focus. With Alpha Focus, I am able to narrow down to India or other markets and get more aggressive exposure there. But in the case of all-weather, I don't do that. And that's the reason why there's no change for India in there. It's also important to remember that all-weather strategy and Alpha Focus strategy are designed very differently. So I'm not just building off of one. They're very different types of strategies. All right, those are excellent questions. Any more questions? We have 231 people on the call. I appreciate that on a Monday. Is it Monday? It's Monday. Another week started. Yeah, my morning started with some fantastic yoga. I hope yours start with some exercise at the park or whatever. All right, any more questions? We don't spend too much time. Just go through the foundation, the basics, go through any changes, answer any questions, and then we're done. And I think we're done. I don't see any more questions coming in. So unless some questions come in, I'm going to tell you, okay. Anjali says, please kindly explain about Japan. I heard from today's phenomena that we should move out from Japan. What does KJPX different from others? I don't have a good answer right now on JPX different from others. It's just the instrument that we've used to get that exposure. Phenomena says we should get out of Japan. Well, yes, and Phenomena has some very great views on things. But remember, I don't listen to Phenomena. I don't listen to anybody. I have a framework and I follow it. And my framework is telling me stay in Japan for another 3 months. So it could be that Phenomena is right and they're getting out of Japan just at the right time, or it could be I'm right and we're going to continue to run with Japan for the next 3 months. But the main thing you'll know about my style is that when 3 months comes, I'll reconsider whether we get out of Japan, and we may go to 5% in Japan instead of 25. I hope that answers your question. Are there any other questions? Make sure to type any questions that you have in the chat. When it comes to being right and wrong, what I learned in my career in the stock market is that you're going to win some and you're going to lose some. Don't get too excited when you win some, and don't get too depressed when you lose some. The key thing is not getting knocked out of the game, and that means protecting your downside. And you've seen how we protect the downside in the different portfolios using bonds and gold. All right, well, I think that is it for today. I appreciate talking to all of you guys, and it's great to see everybody here. And hopefully you're getting your questions answered that you have, and hopefully you're benefiting from what we're doing with the strategies. Most important thing is, remember, I'm not your advisor. You got to talk to your advisor, or you may be taking care of your own money. That's fine. But what I'm doing is showing you my strategy, and then you've got to decide whether that fits your needs and desires. The reason why I come on here is so you can also ask questions about my strategy, so you can determine whether it fits what you need. I want to thank everybody, and I look forward to seeing you again in about a month. And when I see you again, I hope that we're talking about good performance. But remember, if we talk about bad performance next time, then it's the way it goes. You win some and you lose some. ABB says, what will you have for dinner? Yeah, that's a good question. I'm going to be teaching the Valuation Masterclass Bootcamp at 6 p.m. tonight. I love to spend time with my students, but I'll probably have some dinner at home with my mom. And we'll probably eat about 5 p.m. But if I don't have time to eat at 5, I'm going to eat at 7 after the boot camp. But I don't know yet what I'm going to eat. All right, everybody, have a great day, and I will see you in a month. Feel free to ask me any questions anytime, and I will talk to you soon.